Good morning. This is Kelly Fasterling. In our last financial video, we talked about the pensions in America and in the federal system. That pension in the federal system is called FERS, Federal Employees Retirement System, and it is what basically pays you for life based on your years of service and your salary, your last 3 years of salary. So I spent a lot of time on that one in the last session. Today, we're going to look at all of the benefits, especially in the federal system, although many of them, the concept is very similar to what you'll find in the private sector, in the corporate sector. But in the federal system, there are many other benefits and they play together. And a decision that you make with one benefit may impact the options available in another benefit. So it's very important to understand how these benefits interplay. A second huge benefit in the federal system is what's called the TSP. That is the same as what you see in the corporate or private sector as a 401k. It is that mechanism that you're going to save additional money to help fuel your retirement, that difference between what you'll get in Social Security, what you'll get in FERS, and what you want. So that TSP will fuel that. I will spend numerous sessions going over TSP, the different options, how it works, what you can do, different recommendations. So we'll cover that particular topic in future sessions. So today I'm going to focus outside of those two big benefits, the FERS pension, the TSP savings capability, and I'm going to focus on some of the other benefits. So let's start number one with healthcare. Healthcare inside the federal system is called FEHB, or the Federal Employees Health Benefit. Again, these concepts will relate to outside options. While you're employed, though, in the federal system, you have hundreds of carriers to choose from. A lot of employees sit with the Blue Cross Blue Shield option, but there are lots of options depending on what you need. Now, the government is picking up about 72% of your premium. If you're a postal worker, they may pick up a bit more. And then your premiums are paid with pre-tax money. And you'll see adjustments and changes in those premiums periodically. There's an open season for these benefits in the November-December timeframe. Now, when you retire, those benefits can become critically important, especially if you're retiring before age 65 when you're of Medicare age. So if you want the FEHB benefits for you and maybe you and your spouse in retirement, then we're going back to that FERS pension. You need to retire on an immediate pension to carry those benefits into retirement, not a deferred pension. So because many federal employees may have been in service for many, many years, may have met a minimum retirement age and want to retire prior to age 65, you need to consider what that bridge plan is for your medical care between your retirement of age, let's call it 60 or 62, and age 65. And FEHB is a great carryover into that system. Now, when you do become Medicare age, 65, you can consider whether you switch over to a Medicare plan, whether you continue to carry FEHB, or whether you do both. So you'll have some options at that time. And what I'd recommend is that you get with a Medicare advisor that understands the federal benefits, that can walk you through what those options are. I have a client, Jane, who did retire at age 60. She retired on an immediate FERS pension so that she could carry her FEHB for her and her husband, Bill, all the way through their retirement if that's what they wanted to do. Now, to be able to carry that FEHB medical benefit into retirement, you have to be enrolled as an employee, enrolled in FEHB for the 5 years before you retire, immediately before you retire. Now, your entire family does not have to be enrolled for that whole 5-year period. But if an employee dies while in service, that family needed to be on the coverage to be able to continue the coverage. So there are some employee, spousal, family considerations as you look at how you sign up for FEHB and the protection for your family. The FEHB premium tends to carry into retirement, again, paid with after-tax money, so you might have a little bit more taxable income. In most government agencies, the government will still pay their percentage of that premium even once you retire. So as a consideration for retirement, that's something you want to check with your agency is, will they continue to pay that portion that they've been paying of your FEHB premium? Now, if you do cancel FEHB, it's an irrevocable decision. So you want to plan for that accordingly. In some cases, an employee can suspend their FEHB to use a Medicare-approved HMO or TRICARE and can re-enroll later in FEHB, but again, talk with your agency, talk with OPM. If your spouse is on FEHB and you want to have your spouse have that coverage in and through retirement, there's one other consideration that comes into play. That consideration is how you take your survivor benefits on your FERS options. So your FERS is your pension. We talked about this last time. You can take your full pension with no survivor benefit, or pay 10% for a 50% survivor benefit, or 5% for a 25% survivor benefit. If your spouse needs FEHB through retirement, you need to take one of those two survivor benefits on your FEHB. So that's the medical benefits kind of in a nutshell. You also have in federal service a dental and vision plan. It's called FED VIP FedVIP. You can keep it if you retire on an immediate pension, just like on the medical side, but there's no 5-year rule, and you can enroll after you're retired. Considerations there to just double check on. Now, the federal service does also have a long-term care insurance policy. It's a group long-term care policy called FLT CIP. It's available not only to you as an employee, but also to family members, and you can enroll at any time. The premium for this benefit is based on your age when you apply, and those premiums can adjust. As you see with long-term care insurance outside the federal system, the premiums can shift and adjust. In 2006, a big adjustment was made, and those premiums went up about 83%. So the benefits can change, the premiums can change. There's really no promise for service in that long-term care insurance benefit. The maximum daily benefit for long-term care is usually set based on a number of years of care coverage, like 2 years, 3 years, 5 years. So that would be a consideration when you're looking at establishing long-term care. Now, we're going to talk more in the next session about specifically different ways to cover long-term care, nursing homes, cover terminal or critical or chronic illnesses. We'll spend a little more time on that topic in the next session and different options there. In the federal system, there's also a life insurance benefit. It's called FEGLI, Federal Employee Group Life Insurance. It's group term life insurance while you're employed and not particularly intended for post-retirement, but can be used post-retirement. Most employees get FEGLI and sign up for FEGLI when they start working. And then occasionally there's that rare open season. We saw one in 2016, one in 2004. Or if you have a qualifying life event, a change in your family, like you get married or divorced, lose a spouse, have a child or adopt, there are some qualifying life events that can allow you to engage with FEGLI. Now, postal workers don't pay for their FEGLI coverage, and so they're not going to see it on their pay stub, but they will have that coverage. So there are 4 different insurance options while you're working in the FEGLI system. The basic insurance is your salary rounded up to the nearest thousand with 2,000 added. So let's say you're making $79,500 a year. It would round up to 80,000 and add 2,000 to it. That would be 82,000 of death benefit on that basic coverage. Now, based on your age, you might get additional death benefit coverage. If you're younger than 35, then you could get 2 times that death benefit coverage. Between 36 and 44, you can get between 1 and 2 times that coverage. And then once you hit 45, it's 1 times your salary. And that's just real good basic coverage. You see that out in the corporate world quite a bit, with kind of 1-time salary being a basic coverage option. Now, FEGLI also allows 3 other options for the employee and potentially the employee's family. Option A, for a fee, the employee can add increments of 10,000 of coverage on the employee. In option B, the employee can add multiples of their salary times 1, 2, 3, 4, or 5 times. And so they would be basically paying for that additional term life insurance coverage on themselves. And so they can choose that amount they want. And option C, they're buying coverage on their family member, on their spouse, or on their children. And they're buying those in units. So they can buy 1 to 5 units of coverage. For the spouse, those units are $5,000. So they could buy 5,000, 10,000, 15, up to 25,000 on their spouse. And on their children, all children basically for one price, those units are 2,500 apiece. So 2,500 up to 12,500 on the children through age 18 or even up to age 22 if they're a full-time student. So you can remove or request a refund on premium if the employee is no longer has eligible family members. The children are grown, there's a divorce or a death in the family. Those options can be adjusted and changed. So what about FEGLI and carrying life insurance when you retire? So you're eligible to keep your FEGLI insurance if you're rolled in the basic plan for 5 years before your retirement. And you retire on an immediate pension, SERS or FERS pension. And with FERS, if you've met that minimum benefit age of 10 years, the minimum retirement age of 10 years. You can also make an election once you retire to keep all of your FEGLI, some of your FEGLI, or none of your FEGLI as you move forward. And you get to make that choice independently on each of those segments. on basic, A, B, and C. So you can keep all that coverage. You can have it reduced to 50% coverage or reduce down with a 75% reduction down to 25% coverage. So all of those are available options. Now, if you take that 75% reduction in coverage, your Fegley Basic is free. It's a good deal if you have enough coverage outside of Fegley that should you pass, your family will be okay. So, for example, if you leave your job and you have 100,000 salary with that basic coverage, you'd end up with about 25,000 in death benefit. It would drop month by month by month, about 2,000 a month, until it's settled in at 25% of that original basic benefit. Now, if you select a 0 or 50% reduction, you'd still continue to have an ongoing bill for your life insurance. With option A, those 10,000 increments, there's an automatic 75% reduction upon retirement. And it gets more and more expensive through age 64, but at 65, that's free. So look closely at those options, at the ages and at the premiums that carry. Now, option B, that 1 to 5 times salary, it's a great benefit in early years, under about age 45. Now, as you move into retirement, you can select a full reduction and have no coverage left. Or you can select no reduction, but the premiums get very high. At the point in time you hit age 45, they start to double every 5 years. So if you're in Fegley and you have, let's call it 5 times salary with Fegley B, look very closely at the premiums you're paying, because there is a potential that you could get outside insurance, the same coverage, the same death benefit, for a lot less. It's worth considering and looking at. So what should an employee consider when they're planning their life insurance needs in retirement? You know, that Fegley decision, when you elect to let it go, that's irrevocable. And so you need to understand what your insurance needs are. You know, the costs of your coverage to cover your income, your final expenses, mortgage that you may still have, legacy, if you have legacy to charity or to children, college debt that you're trying to cover. You want to make sure all of your insurance needs are being accommodated and that you're not short-sighted in that. But again, with the amount of coverage with Fegley based on salary, that can become pretty expensive in later years. So quite often that private sector life insurance is less expensive, but the other consideration is, would you qualify going through underwriting? So anytime you buy additional life insurance, they may require you to go through full underwriting, which is them looking back at your medical history, talking to your doctors, making sure they're willing to insure your life. So Fegley can be converted at retirement to a permanent life insurance product with guaranteed acceptance to certain OPM approved carriers. That's another way to look at continuing the option, maybe at a different premium cost. So to sum it all up, in that federal space, there are truly some amazing benefits to prepare you for retirement with your pension with FERS and your 401k or TSP that allows you to create that augmentation to your retirement. The ability to carry your medical benefits into retirement is an extremely valuable benefit. The ability to take your dental and vision in, to carry your life insurance and your long-term care should you need to. So you have a lineup in the federal system of some very, very strong benefits that are well worth considering and looking then at the impact of how these benefits work together. So that is all for today. Thank you for your time. If you have any questions, just feel free to reach out to me at any time. Take care and have an awesome day.